So thank you to the organizers, Jose, Raluca, and thanks everyone for joining. I'm very excited to be presenting to this audience and would love to connect with anyone if I have the opportunity to do so afterwards. As Jose mentioned, the title of this paper is Are Nonprofit Banks Special? The Economic Effects of Banking with Credit Unions, and it came out of my dissertation work where I was interested in the role that nonprofits play in the economy. And I ended up, having access to this consumer credit reports data and learning kind of by coincidence that credit unions play a significant role or a significant source of nonprofit participation in commercial markets in the United States. And that's kind of, the genesis of this research project. So one way to motivate this question is, why would you be a nonprofit when you could be for profit? And there's like a range of answers to this question that begin from the most, say idealistic or optimistic, thinking about altruism and the nonprofit form as being perhaps the most natural organizational vehicle for expression of some sort of altruistic motive. To somewhere in the middle, there are contracting failure type theories, which emphasize the lack of trust or sufficient trust in for-profits, and the nonprofit distributional constraint that is self-imposed, sending a signal about the quality of the product to the market as allowing the contracting failure to be overcome, at least partially. And so this kind of theory in the middle kind of emphasizes a trust problem. And there perhaps less optimistically or most pessimistically, you have the view that nonprofits simply take advantage of tax and reputational arbitrage. And the answer to this question, I think, matters because nonprofits have grown significantly in terms of our GDP over the last half century or so. And if we think that the nonprofit is a useful vehicle for something, then this erosion of trust in the nonprofit form, if it is the case, as it is, a commonly held view among economists, then this erosion of trust in the nonprofit form means that we are kind of losing a policy arm. At least that's one way to motivate the importance of nonprofits. And then perhaps most precisely, given that we have policy aids for nonprofits in the form of a tax exemption, well, this tax exemption could either be harmful or insufficient, depending on where the answer kind of falls. Now, as I was kind of alluding to, I think banks are an interesting case study here. We have a relatively clear, at least putative, objective function in the case of credit unions because they're cooperatives. So their idea is they're supposed to be helping their members. We have relatively good data, and yet these are relatively understudied, at least in academic literatures. And I think it's particularly interesting setting because it helps us think through the related costs and benefits of alternative banking models. As some of you may know, most of the economics literature related to nonprofits is, at least empirically, motivated by case studies of the hospitals sector in the United States, which is another sector where there's a lot of nonprofit participation. And the stylized fact or view that arises there is, as you can actually see this in New York Times articles related to this, there isn't much of a difference in how we understand nonprofit hospitals than for-profit hospitals. And so I'm trying to kind of add another sort of industry, in a sense, to the setting, but opening up a lot of other kind of side questions at the same time. Credit unions, as perhaps no surprise to this audience, are growing in household lending markets. So the weakened restrictions on their customer base over the last 2 decades have allowed their membership growth on the one hand. Now, they are not a very sizable portion in terms of assets under management, but in terms of how they reach consumers, they're a very large portion of the experience of banking for consumers. So they have about 120 million memberships, depending on how carefully that figure is double counted. It gives you a sense that somewhere close to 25 to 30% of the US population has some type of relationship with a credit union. So that's a significant reach. And then in terms of market shares, credit unions have about a quarter of personal loans. They hold very little in the credit card segment. They had about 13% of the market share in mortgage originations in 2017, and they're a bit over a quarter of the auto loans market. So considering their significant traction in consumer lending, I think these are relatively understudied, and they're an important part of these markets as well. There's also a policy angle, as I alluded to earlier. Credit unions are tax exempt, and perhaps no surprise, to the bank lobby, this is not pleasant. So here's a quote from the American Bankers Association that says, though credit unions look and act like banks, they do not pay taxes or abide by the same rules as banks. So this kind of captures the sentiment that would come from the view that basically credit unions are for-profits in the disguise of a nonprofit organization, taking advantage of the tax exemption. On the other hand, though, you have credit union advocacy groups that kind of state that the mission of the credit unions, which are nonprofit cooperatives, both of those portions are very important to how we understand a credit union, is basically they are people helping people organizations. And the way in which they deliver value and justify any sort of policy advantage is that they offer better prices and they give better outcomes, and they'll do things like provide financial education for their customers. So in this paper, what am I going to do after kind of presenting a little bit of motivation for it? Well, I'm going to kind of try to organize this presentation in terms of 3 questions, 2 which are kind of precise in the sense that I'm going to give data for, and then the third, which is sort of like an emergent kind of question, or like I'm going to provide emergent evidence for it. So the first is, do credit unions select for different types of borrowers? So, thinking about this in terms of applied economics, is there like big selection kind of going on into credit unions, the difference than competing banks? Then thinking more in terms of a potential treatment effect, I'm also going to ask, do credit unions do something different? Do they offer better prices? Do they yield better credit outcomes? And, using the collage of evidence that I gather in these 2 questions, I'm going to be trying to make an inference about whether they seem like for-profits in disguise. I don't have like a sharp statistical test for whether you're a for-profit in disguise, but the idea is to interpret the evidence on the first 2 questions to give you a sense of what kind of nonprofit are we dealing with.
Can I ask you a question, just clarifying? You mentioned that the restrictions that credit unions face in terms of getting customers has changed over time. Do you have kind of a little bit of context there for those of us that are not familiar?
Yeah. So I think the most concrete way is that it is now possible for credit unions to have dual membership bonds. I'm going to explain a little bit about these, common bond requirements. But also the enforcement of what is a member is not a very strict thing. So just to give you an example, the largest credit union is Navy Federal. So, it used to be that you could join Navy Federal if you were, I think, very, very, tightly related to the Navy. Then that became, armed forces. And that also includes family members of the armed forces. So little by little, the set of people that can become a member grows. And
so
to give you another,
is there kind of a timing where some policy changed, or this just has been kind of eroding over time?
Yeah, that's the latter is my view of it. I don't have a very precise kind of thing where a regulator did X and then all of a sudden the floodgates were opened kind of view of this. I know that there has been court rulings that have made some things easier to do, but I don't think it's the kind of thing where a law passed and it made all of a sudden a big difference. And just to give you another idea of this weakening, it's not hard for many credit unions, depending on how they've defined their field of membership, to give you an option that if you don't qualify under the strict definition, you can become a supporter of that group by, say, making a $5 contribution to that group and therefore qualifying for it. Okay, but that's a good question. I'm going to try and kind of return to that, but that's a good question to keep in mind as we're thinking about selection effects as well. So the data I'll be bringing to this paper are basically twofold. One is credit records from TransUnion, and this is depersonalized but individual level credit records. TransUnion is one of the 3 major credit rating agencies, the ones that produce the credit reports, credit scores, and any sort of other related information. And the Home Mortgage Disclosure Act data, which is the closest thing we have to the universe of mortgage originations. And the approach that is in the paper and that I'll follow in this talk is first just describe to you at what I will call the correlational level of evidence or descriptive evidence about differences in outcomes between credit unions and banks. And then I will motivate why we need to go beyond those descriptions or correlations and why we need to think in terms of causal effects. And I'll be using an instrumental variable approach to go there. So that's kind of big picture, the structure of the argument of the evidence that I'm presenting. And let me give you a kind of quick preview of where I will conclude. Do they select different borrowers? I don't find strong evidence of strong differential selection in the types of borrowers. Do they offer better prices and credit outcomes? The answer seems to be yes. Do they seem like for-profits in disguise? I'm inclined to think no, based on this evidence, right? And that I'm using those words carefully, inclined to think no, because of the kind of the nature of the question and the nature of evidence that I'm putting forward. So here's the outline for the rest of the talk. I'm going to give you a little more background, although I'm afraid this background may be not the most relevant for most people in this audience, but still useful to kind of refresh. I'm going to talk about the data. Then I'm going to give you this aggregate or correlational level evidence, motivate the causal analysis and show you the arguments for it. And then I'm going to show you a little bit more on mechanisms and some extensions that kind of give a little bit more of description of what may be behind these differences between credit unions and banks. So first of all, let's imagine, we're talking about the difference between a nonprofit and a for-profit. How would we expect this in principle to play out? Well, here's one way to kind of like stretch our brains to think about it. Here's the income statement of a for-profit organization, for-profit bank, actually. It makes money by making interest on loans, and its key, operation, or its key like business-related cost is the interest that it charges on deposits. It has to pay this out to be able to raise funds, and then it kind of gets money from interest on loans. Then you also have operational costs like salaries. Then you have the losses on unpaid loans, operations and equipment, and in some ways those are comparable to any other organization. We kind of have something that we're going to call net income. Then after that, you have to go and pay taxes on that money. Then you have net after-tax income, and then you have something called cash dividends, which you distribute to the owners and the controllers of your organization if you're a for-profit. Now let's think what happens when you become a nonprofit in the United States, at least, where you have a tax exemption. Well, your income tax kind of line gets eliminated, but also very importantly, this notion of cash dividends gets eliminated because there's no capacity to distribute excess revenue over costs to the people who control this. That's what the literature calls the non-distribution constraint on the nonprofits. Then you want to be thinking, well, this net income of 3, where is that going, basically? In principle, if this is a nonprofit, that should kind of, on a one-period sense, that should be approaching 0. And therefore, it should be kind of flowing back either to lower interest on loans or higher interest on deposits, higher salaries, higher losses on unpaid loans, higher operations and equipment costs, right? Each of those kind of has a different view of what the nonprofit is achieving. But just to give you a sense. Now, this is one way to understand it when you're thinking about a nonprofit in 1 year, right? Now, the reality is that nonprofits exist over multiple years. And so what is really going on is that this net income can also be carried on to future years. So it doesn't have to necessarily affect the first year's, line items. It can be carried on to, maybe investments in capital equipment and so on and so forth. But the idea here is just to say, like, where is this going? If it was all going to salaries, for example, we may be a little concerned about the nonprofits in disguise kind of argument. If it's going to lower interest on deposits or higher interest on lower interest on loans or higher interest on deposits, we would say, well, this is kind of returning the money or the rents back to the customers or the borrowers or members in the case of credit unions. And there's a literature on commercial nonprofits that is kind of long in the theoretical sense. As I mentioned earlier, the focus and motivation has been on healthcare sector because there's empirically, there's a long tradition there. There's relatively little attention to nonprofit banks, although some research does exist, and it does suggest that lower prices at credit unions are delivered. And these two theories that I focus on that help me interpret this kind of third question of are they nonprofits in disguise, you can think of it as the altruism theory, which predicts that nonprofits will have lower prices. And then you can think of another one, which is solving the non-contractable quality problem, as actually predicting that nonprofits will have higher prices. And what the intuition there is that, to be able to signal that you will have higher quality, you have to kind of charge more. But you're still kind of tying your hands to taking these profits home. And so, this sort of solves the informational quality on the hidden equality problem. Now, let me give you a little more detail kind of to Jose's question about the institutional features of credit unions. Credit unions are member-owned cooperatives, and that means that there is one member, one vote. So there's in principle, very democratic organizations. They have volunteer board of directors, which of course are delegated much of the decision-making to. They cannot issue capital stock. That's the non-profit part. That means that there is no concentration of control. And perhaps the most unique thing in terms of, I guess, nonprofits, cooperatives in the US relative to the rest of the world is that in the United States, they are organized around something called the membership field. Nathan, I see you raising your hand. Let me just finish this point and I'll pass the word to you. And these membership fields define the potential list of clients. And just to give you a sense also through these examples, gotcha. So just to give you a sense of the potential variety of credit unions we have in the United States, by way of these 3 examples, let me give you an example for each of these 3 broad categories of fields of membership. First is occupational. Think of that as your primary employment base. A very prominent credit union is Navy Federal. People who live around the DC area are likely to be familiar with them, serve primarily armed forces members. They have more than $150 billion in assets under management. They're well above, a lot of the regulatory thresholds. And so they're a big financial institution. They compete with regional banks that have national reputations. You also have associational fields of membership, and this, think of it as a religion, for example. And I chose very purposefully Holy Trinity Baptist Credit Union. They have about $20,000 in assets under management. That's more like a household balance sheet. And so I chose the 2 extremes just to give you a flavor of it. Now, importantly, Holy Trinity is not doing mortgage lending. They're really servicing minor loan needs at a religious associational level. But that's also a credit union. And then you have something that has grown a lot quite recently. They're referred to as community fields of membership. I think it's best understood as geographically defined fields of membership. And so I found one that's servicing upstate New York area. It's called Adirondack Regional Credit Union. It has about 50 million in assets under management, and it serves anyone who works, lives, commutes through, or kind of goes to church in the 5 counties that define their field of membership. And I mean, I'm not sure to the degree to which it's super relevant, but it may be interesting to some of you. The historical justification, at least I was able to find out by digging into some of the history here, is that the motivation for providing credit unions with a tax exemption was based on the idea that they would serve something of a restricted consumer base, kind of focusing on low to middle income customers and a small set of products. Now, this may or may not be kind of relevant now. There's nothing in the law that requires this as a condition for the tax exemption of credit unions, but it seems to be like some of this thinking was behind at least the laws that shaped credit unions as we see them nowadays. And the last thing I wanted to say is that credit unions are smaller than banks in general. Here you have the total assets under management in 2017 in terms of the density of them for credit unions and banks. And so you see that the left tail is much more populated by credit unions, the right tail is much more populated by banks, but there is a significant amount of overlap. And one useful way to use this picture is to think that what I'm trying to do is find the region of overlap between them and compare mortgage lending among those banks and credit unions that are competing with each other in this sense, in the sense that they have similar size and capacities. So that's all I'm going to share on background. Next, what I'll do is I'm going to go into a little bit of the data that I'm using. I'm going to tell you about the source. I'm going to try to convince you that the sample that I end up studying is representative. And then I'm going to give you a little flavor of how I back out some interest rates from the credit records data, which is basically a quantities of credit data set. Okay.
So can I just...
Please.
We were talking before, about, who originates mortgages in the banks, and we kind of came to the same agreement that most of them are originated by larger banks. So that would kind of suggest, that maybe larger banks, if your focus is on mortgages, are really the comparison group here. I'm not saying that my argument is better. I'm just saying that is just an alternative way of looking at it.
Yeah, for sure. So in terms of like, I think from the consumer perspective, where would you kind of get a better deal? I would say actually I prefer that view. From the perspective of what is a nonprofit doing, I actually kind of prefer the view as thinking, okay, if I am a depository institution and I have this size, what effect does the nonprofit constraint impose upon me? And from that perspective, I prefer the sample of comparing, the depository institutions with similar assets under management size. That said, in the paper, I do both. I do both analyses, but then I end up kind of focusing on the comparison to small banks. But definitely, like knowing how they fare compared to both is definitely relevant.
Andres, there are some comments in the chat. I don't know if you want to take them now or later. I just wanted to let you know. I can also read them to you, or maybe the people can.
I'm seeing here the differences in market shares for first versus second mortgage liens. Yeah. In terms of could affect also non-interest. Yes, that's right. Yeah. So non-interest fees is, I have a little bit of a robustness check about, I think the comment here is getting to, are we sure interest rates are the entirety of price, right? Like prices in mortgages are more than just the interest rate. There's a ton of origination fees. There's kind of point discounting, the kind of thing. And I mean, I do my best to kind of allay those concerns, which I myself have. They're kind of there in the paper. Let me see. I would like to know that credit unions also net income is also added to institutional capital. It's the only way. Yes, that's right. That's right. So this gets to the point about how my kind of like simple income statement is a one period analysis, but really, you can just kind of defer, income or retain income, right? And that's important. So like, I think the better way to think about the tax exemption is that it's a relative advantage on retained earnings, more so than profit, because there is no such thing as profit in the nonprofit world. So what does it do? It actually is about, what do you do in the next period? That's definitely.
I think Andrew has a point here about first versus second mortgage. Yeah. Do you distinguish those in your analysis?
So not the second lien, but
I think first mortgages are generally a non-recourse. Second mortgages can be recourse. So in that regard, they might be different.
So I distinguish between first-time originations and refinancings, but I don't include second liens.
Okay, so you're only looking at first liens. Okay.
Mm-hmm. That's right. Okay, so I would like to, yes. And yes, a comment about, if this was an economist one, credit union, we may be a little more suspicious of. We got trained to think about the suspicion. Okay, so let me go into the data of this. So what am I doing? I'm using depersonalized credit records from TransUnion. I have a 10% sample for about 20 years, and this is data on the individual as well as each credit line that the individual has. And I merged this with about what is 90% of the universe of mortgages originated. And this 90% is not 100 because of some regulatory reporting requirements. But it's the best thing we have that's closest to the universe, right? And what I do is a fuzzy merge between these two data sets. I call it a fuzzy merge because I look for unique instances of mortgages at the census tract, year of origination, and loan amount level. I make sure I'm only trying to match those that are unique in that kind of cell combination. And then I try to find a match in the TransUnion records data for it. The result of that is about 5 million loans that were originated between 2004 and 17. And then I further reduced the sample for the reasons Jose and I were talking about earlier to about the 1.2 million loans that were originated by credit unions and what I'm deeming comparable or small size banks. If you want to have a sense of the match quality, 10% is the maximum I could ever hope to match, right? Because I only have 10% sample from TransUnion. And you can see here that TransUnion does a data change in 2009, which improves the quality of the data. And so my match rate improves significantly after 2009. But the way I interpret these is that I'm matching anywhere between 10% and 80% of the loans that I'm trying to match. But that does not also account for the fact that I'm excluding.
The same throughout my career.
Hello? Sorry. Oh, anyway, so that does not include the fact that I'm not even attempting to merge, all of them because of this kind of requirement that there be uniqueness within each cell. And then just to give you a flavor, like the simplest way to think about the representativeness of the sample that I end up with. And the nice thing here is that because I have HMDA, which is the quasi-universe, I can always go and compare my sample to the quasi-universe, right? And so in black, what I have here is the fraction of mortgages originated by a credit union in the sample that results from my, merging procedure. And in blue, you have the fraction of mortgages that were originated by a credit union in HMDA, which is the quasi-universe. And so you see that there's a small difference in levels, but you see that the variation over time tracks quite well. And so this is, I interpret this as an encouraging sign about the representativeness of the sample. A little more rigorously, I do, take the means of various variables that I have in both my sample as well as in HMDA and try to compare how did my sample end up being different than the universe. And what you find is kind of what you would expect in the sense that once you start thinking that there's going to be a selection effect through the merge to TransUnion, you'll get that my sample has loans that are slightly larger on average than in HMDA. Right? And that's because, larger loans tend to be more likely to get reported to the credit records agencies than the smaller loans. Now, importantly, though, this effect happens both for credit unions and for banks. So there's not like a differential level of, inconsistency between my sample and the HMDA at the credit union versus bank level. So that's kind of like the thing you want to keep in mind, that my sample focuses on slightly larger loans than perhaps the population, but we can move forward with that kind of caveat in mind. Now, another interesting thing I think in this paper, which people find interesting, is how I get interest rates out of this data set. Now, those of you who are familiar with credit records agency data know that this is basically a quantitative credit. You get things like the balance, the amount of time that is left on this, the monthly payment, whether you're past due. You don't have a measure of prices there. But now one thing that I did with this project was kind of realize that at least for fixed rate mortgages, that's important, for fixed rate mortgages, which by the way, most are for the initial life of the loan anyway. For fixed rate mortgages, you can characterize the life of the mortgage through the present value of an annuity equation, which is kind of this complicated nonlinear relationship here between the balance that's outstanding on a given loan at a given period t, the interest rate, which is fixed, right? So there's no temporal subscript to that. The capital T minus small t, which tells you the amount of time left on the mortgage, also known as the maturity, the monthly payment amount, and then the interest rate again, so on and so forth. It's a complicated nonlinear relationship. But what's important to know is that in the credit records data, I have good data on the balance amount left on any mortgage at any moment in time, and the amount of time left on that mortgage. So that's not quite enough by itself to get me the interest rate on the mortgage. Why? Because I don't have good data on the payment. So there is a payment field, but in the case of mortgages, it's problematic because it includes other information that kind of muddles this inference. But because I have two of these variables, and importantly, I have multiple observations of this data. So I have it for month 1 and for month 2 and for month 3 and so on. Basically, I have enough variation to create a system of equations where with any 2 months of data, I have 2 variables that I do know and 2 variables that I don't. And so kind of going back to our high school math, this basically becomes a system of equations with 2 unknowns and 2 knowns. And so it's a solvable problem. And what I do is I develop an algorithm using multiple of the first months of data that I have on any given loan, try to back out the interest rates for these based on this kind of present value of an annuity equation. And because I have multiple months, I can generate many different observations for it, and I can be picky about what I call a good inference or not. I'm calling that, academically an over-identification consistency constraint, which is basically saying if I look across the months, I need to find the same the same inference, and then I'll become confident that this is a good inference.
So, Andres, you have about 30 minutes. By the way, we have done similar type of imputation internally too, so a lot of people probably are familiar with
That's great to hear.
type of analysis. Yeah.
Okay, great. So, let me then push forward to say I can't do this for all the sample for many of the reasons already alluded to, but I can do this for about 2/3 of the sample. And I kind of validate this with, getting the interest rates that I generate from my sample with my algorithm compared to like market averages from Fred. And it's really encouraging that they line up so well temporally, because there's nothing in the algorithm that would generate temporal variation in these. Okay. So let me then go to the first set of results, which I want to emphasize is just kind of descriptive, right? First, I'm going to give you a sense of what market segments credit unions focus on. Then I'm going to, give you a little bit of sense of what kind of outcomes and price differences we see between them. The first, I'm going to spend like a minute just explaining this graph, because then I'm going to slide through about 8 of these. And so I want just to kind of like be able to kind of read them quickly. What I have here is the density of geographic measures of the mortgages that are originated at credit unions and comparably sized banks. And so what I do here is, based on the HMDA data, I figure out what is the rejection rate of mortgage applications at the census tract level, assign that rejection rate to the mortgage, and then calculate the density for all the mortgages that were originated by a credit union and by a comparable size bank. Importantly, I'm looking at the HMDA data. So this is the closest data set we have to the universe. And you can basically see that, well, I have a lot of data, so it's not hard to reject any difference in means kind of statistical test. The more important thing here is whether there's any economic difference between them. And as you can see, these distributions are highly similar. There isn't like any, drastic difference in where credit unions and small banks seem to be originating mortgages. So this is rejection rates at a geographic level. This is credit worthiness at a geographic level. You see very similar, patterns in geographic credit worthiness at where they are originating mortgages. This is geographic income, also very similar. And then this is the fraction of the tract that's urban or not urban. And you see that credit unions compared to small banks tend to be a little bit more urban focused. And this is different compared to big banks, which are even more urban focused. But relative to small banks, they tend to be more in the cities. Then the next thing I'm doing is I'm just distributing plotting the distribution of loan amounts by credit unions and small banks. And we do see a small, notable difference here. And the credit unions do tend to originate smaller loans more so than small banks. That's an important thing to keep in mind. But this is also a variable I have. So when doing the analysis, the causal analysis is something I can easily control for. In terms of applicant income, I would argue that economically there's not much of a difference between the population that they originate mortgages for. Rejection rates are also kind of similar. They have a kind of slightly different shape, but it's not easy to make much of a difference between these. And here's something that does strike me as important in difference. So now this is the fraction of mortgages that get resold to the secondary market within the same calendar year that the mortgage was originated. And you see here that on average, a credit union sells 30% of the mortgages they originate to the secondary market. That means they hold 70% of them on their balance sheets. Unlike small banks, which sell 60% and only hold 40% on their balance sheet. So this kind of is a potentially important thing, and I'm going to come back to this towards the end of the talk, because you may well recall that a lot of the problems of incentives described with origination of mortgages prior to the financial crisis were attributed to kind of these problems of not having incentives in the right place, right? So credit unions, I'm not saying what the reason is, but for whatever reason, tend to hold mortgages on their balance sheet much more than banks do. So let me just summarize, because that was 8 plots. Credit unions do have a slightly more urban focus, and they do smaller loans than banks, but they're otherwise very similar. Their distributions overlap considerably, and I would say that they are much more alike than they are different in terms of who they are serving with their loans. Importantly, though, there's this kind of thing that I picked up, that they're more likely to keep mortgages on their balance sheet. That's not about who they're servicing. That's just more about the banking model they follow, right? And let me give you what you would see if you were to download list price data on the differences in interest rates between credit unions and banks. You would see that most loans, you have a higher interest rate at a bank than a credit union, right? So you get You get a negative difference between the credit union and bank on a loan. That means you have an advantageous rate on the loan side, and you also have an advantageous rate on the deposit side. Interestingly, the market that I'm able to study due to the quality of the data, which is the mortgage market, is where just at the list price level, you don't see much of an effect. Now, very important to kind of remember that these are just list price data. There's nothing here that I'm doing to control for the kinds of people that they are kind of borrowing to. But an early indication of differences comes from some price data that is in HMDA, which is the fraction of loans that report a rate spread. So a loan has to report a rate spread if they are something like a few basis points above, or some number of basis points above some threshold. And you see that even during the crisis, credit unions kind of didn't do as much of this risky or high interest rate lending that small banks did. So something kind of like is popping up already in this data. And now to perhaps the most data innovative part of this project, an important kind of thing of like using TransUnion data, or the credit record agencies data, is that I can look at how people fare in terms of their credit profiles. So here what you have on the top left graph is the probability that a mortgage is 90 days or more past due up to 4 years after origination. In red, you have the average of credit union loans, and in dashed black, you have the average of small bank loans. So you see that there's this, strong, kind of notable difference in the probability that a small bank and a credit union loan becomes 90 days or more past due. Malik, I see your hands up.
Yeah. Do you do splits pre and post crisis? Given the graph you showed on the previous slide, I'd be curious how much of this is that.
Yeah, I'll show you something related to the end. I'm not sure if it's going to be exactly what you're looking for, but let me push you to the end of the talk where I do something like this. Daniel.
Yeah, I want to point out the distinction you mentioned earlier between credit unions that have a purpose from employment versus credit unions that have a regional purpose. And do you distinguish between that? Because certainly if you're looking at, say, Boeing Credit Union, which is, a very large credit union whose members are primarily high-wage people, that the profile of the loans that they're going to have might be a lot different than a regional credit union that serves a low-income area.
Yeah, so that's a good point. I'm not able to segment them in that category. I have not been able to yet. But
Okay.
What I am able to do is control for things like applicant income, applicant credit score. So it's more like an individual level comparison. I take your point, though, that there may be differences in what arises at the level of the credit union behind these kinds. So in a sense, I think my controls are stronger, but I don't want to kind of ignore that question, because I think there's still potentially kind of important. I just haven't done that.
And I guess the other thing that I would also add is the type of loan. So you might be more likely to expect a credit union to be making an FHA loan or rather than a GSE loan, and so that might come into play. Although FHA loan, Ginnie Mae loans are going to be lower performing than GSE loans. So, but
so
probably more prevalent in that space.
That's a good point. I don't go into detail in the talk, but I basically look to kind of this. I have a notion of a standard loan that I'm comparing here that excludes a lot of these more, like less common types of loans. So I'm focusing on the standard, if you will. Andrew?
Yeah, I was wondering if you did anything related to DTI, debt to income ratios.
Yes.
Obviously,
Yes.
I see credit score, but DTI, you do have some segmentation by that?
Yeah, so in like the causal portion of the paper, which by the way, this is not yet, I have a list of controls, which I'll show you, but that's definitely there. This is simply just looking at like what's the average between credit union loans and bank loans. And so in a sense, you should be skeptical of these.
Right, yeah.
And I'll try to articulate why one would be skeptical of these. But yeah, important to say this is just, raw averages between them. So let me put...
When you look at delinquencies, most of the action happened during the Great Recession. So I think it's important to kind of look at those two periods separately,
Yes.
Just to make sure that you're not just capturing stuff that happened there.
Yes. Actually, that's one of like the subtle nuance points towards the conclusion that I'll come to as well. So you can see the same kind of thing for credit profile outcomes. Wei, if it's okay, I'm going to come back to you after I push forward, just in the interest of time. I'm going to kind of like take a pause at the end of this section and return to you. So I can also do this kind of, simple raw averages comparison at the credit profile level. So instead of looking at the loans of originated by credit unions, I'm looking at the credit profiles of individuals who borrowed at a credit union versus a bank. And so I can look at how they seem before origination and after. And so, I mean, let's just focus on the top left plot, which is the number of trades that are 90 days or more past due. You see that, individuals look kind of strikingly similar, both in the levels and in the path, but then a wedge opens up after origination. And you see similar effects at the amount of past due, credit score, which suffers a big hit for everyone, but it's less of a hit for those at a credit union. And then perhaps most importantly, at the level of bankruptcies. Right. Now, I'm not claiming you should interpret these as causal for all the mentions I had said earlier and things I will say soon, but it is kind of like an interesting observation already, right? Like you just see these and it kind of makes you kind of ask the question quite interesting. So let me summarize and then I'm going to go to Wei's question. What I'm taking from this correlational level evidence is that CUs do have, there's a lot of indications that credit unions charge lower interest rates on some mortgages. But not as much as on other loan products. And then in terms of the credit outcomes of individuals who go to a credit union versus a bank, mortgages are 50% less likely to be past due. Credit scores grow by 1.5 percentile points more, and bankruptcy is less likely among credit score borrowers. But the important thing, so just to transition to the next stage, is that this, in principle, is a combination of things that credit unions do differently and the kind of population that credit unions select, right? So I have not disentangled those two things, at least yet. So let me go to Wei's question.
Yeah, just a quick question about the lower past due rate for between credit union and small bank. Do you think the security offset may explain partially of this disparity?
Yeah, I'm going to show you some kind of evidence towards that. I do think that there's something to it. I wouldn't claim that it's the strongest evidence, but I can happy to postpone this question to when I show you the analysis I've done of how this is a potential channel for these differences.
Sounds good. Thank you.
So, okay, now let me give you...
You have about 50 minutes.
Got it. Thank you. So let me give you a quick on why. My guess is I don't need to go into much depth. But why do we need causal analysis? Well, so far I have shown evidence that credit union and bank borrowers appear similar. Emphasis on the word appear. And that CUs give better interest rates and outcomes. But again, I just said that that's a combination of selection and treatment effects in principle. Now, why do I say they appear? Well, there are a lot of potentially unmeasured differences between these two types of borrowers that are not captured in the data I have, which may be behind these differences in interest rates and outcomes. So the proposed solution in this paper is to use an instrumental variable that for some borrowers kind of gives us a random variation in terms of pushing people into a credit union versus a bank or vice versa. How am I going to construct that instrument? I'm going to just walk you through it to kind of gain some intuition. It's basically a measure of density of credit union branches around the individual's residence. And the idea is if you live or you're going to live around a bunch of credit unions, you're more likely to go to a credit union for reasons that are not related to, your relationship to a credit union per se. You're just going to be more likely to kind of be close to one. That's kind of the intuition here. I'm going to restrict branches to the 10-kilometer radius around the individual's new residence, compute the individual's distance to each of the branches within that 10-kilometer radius. Then I'm going to convert that into an inverse distance so that the branches that are closer have a bigger weight. And then I'm going to normalize that inverse distance by summing all of the branches of credit unions divided by the distances to all credit unions and bank branches. Okay? So just to give a super simple example, if there were 3 equidistant branches from my house, one of them is a credit union and 2 are banks, the credit union density measure will be 1 out of 3. If the credit union happens to be closer, the credit union density is going to be greater than 1/3, right? So it's the fraction of credit union branches relative to overall branches, but weighted by relative distance, right? So the closer, the higher the weight. The intuition here is kind of based on that people don't do a lot of mortgage shopping, basically. People go to 1 or 2 lenders and they kind of figure out what their interest rate is going to be based on proximity. And it turns out that you can see that quite strongly in the data. So basically, if I look at the measure of the credit union density that's the instrument on the horizontal axis, you see that the credit union fraction of loans increases quite drastically with density, right? So this is a very strong first stage in the language of instrumental variables. Now, for the purposes of today's talk, I'm not going to go into defending the other elements that I need to defend about the instrument to make it valid, the exogeneity and the exclusion restriction. But let me just say that for those who are familiar with those literatures, this is not different from the arguments that are made in the literatures that study returns to college, and in particular returns to four-year college versus two-year college, and how I still need to apply a bunch of geographic level controls so that the variation is within the variation in the instrument is within a geography. So the argument there is within those controls, you're sort of kind of ending up in a situation where some population is being pushed into a credit union for quasi-random reasons. Here is like the formal model, the formal econometric model. The first I instrument for whether you go to a credit union with credit union density, the instrument. And then in the second stage, I predict interest rates or all sorts of credit outcomes, like whether you're likely to be past due, go into bankruptcy, your credit score, and so on. Here's the full set of controls. I'll summarize it as controls at the level of the applicant, which include the credit score. Controls at the level of the loan, like the loan amount, its purpose, its term, its lien status, and so on. The tract in which they're located, like geographic controls, and lender controls. This is the specific thing that I have about mortgages, which is special about bringing in HMDA, that I know the identity of the lender, and so I can bring in thing about the lender. And here's like the core result on interest rates. If I regress a dummy on whether you got a loan for credit union unconditionally, I find that you have an interest rate that's 0.189 interest rate points lower by going to a credit union than if you go to a bank. Now, if I apply controls and apply the instrument, so that means applying for observed issues and then like selection with the IV, I find a slightly stronger effect on credit unions, which is about 0.3 interest rate points lower if I'm going to a credit union than to a bank. If you're wondering, I don't know how to interpret that at first, is that a lot, is that little? Well, here's one way to interpret it. Just as a back of the envelope, assume you got a $200,000 mortgage, which is about average in this time period, at a 5% interest rate, 30 years loan, but holding it only for 7 years, and you have a personal discount rate of about 20%. That is about $1,600 in present value of savings, right? That's not, you don't get $1,600 today, it's the present value of it. And that amounts to about 0.8% of the principal. So this is meaningful differences in interest rates. In the aggregate, I do this kind of thing to like look at whether what this would amount to in terms of would-be taxes and so on. And it's a rough calculation, but I estimate that the savings on the consumer side are about 135% of the estimated would-be taxes. Now, I don't take that as a super precise number, but I do take it as this is pretty far from zero. And that's the sense in which I present this number. So summarizing, credit unions offer lower interest rate mortgages after controlling for observable risk and selection. I'm not showing you these results today. I calculated that I would be over time. But if I were to show you the graphs on the credit outcomes, they show qualitatively the same result, with the important caveat that because this is an instrumental variables analysis, the confidence intervals are a little bit narrower. But you still take away the same idea home, that if by going to a credit union, you seem to have a treatment effect that is better not only for your interest rate, but also for your credit outcomes. So in the last few minutes, I want to discuss 5 different extensions or heterogeneity analysis, and they'll kind of pick up on a few of the questions that have been coming up. But before, I just wanted to share with you, if you were wondering, well, this may be very, very specific to mortgages. Well, mortgages, I said, are about 10, 13% of credit unions. Credit unions have about 10 to 13% of origination market share. They have about 25% or more in auto loans, so that would be a great place to look. The reason I don't center auto loans is because I don't have something like HMDA for auto loans, so I can't control for lender characteristics. But I can do a similar instrumental variables analysis for interest rates and all the other credit outcomes. And if there's most of these show the same kind of directional results. Interest rates are lower at credit unions, and if you look at the amount past due, whether you like to be charged off or sent to collection, bankruptcies, credit scores, they're all favorable to credit union borrowers. Okay. Another thing I wanted to talk about was like what may be behind these differences in mortgage results. Well, one thing I show is like the difference in prices at the credit score distribution. And you see that the biggest difference is coming from individuals with the lowest credit score. So that's where like the biggest bang, and kind of this is consistent with this cooperative model of credit unions. Well, you will see that there are still meaningful differences in interest rates towards the end of this region, but there are large, even though harder to measure, differences among those with lower credit scores as well. So there's a difference in the pricing function that seems to be less risk sensitive. I can also compute the counterfactual individual prices using my full model. And I find that for the vast majority of borrowers, they would end up with a better interest rate if they were going to a credit union. That's kind of what this is showing. Now, another thing is, the results, taking the idea of, there being a treatment effect by credit unions that's different, means that there's something that's happening post-origination, right? If it's all pre-origination, it's all selection. And that's, interesting too. But it's not as interesting, I think, if there's more that's happening post-origination. So one thing I do to look at this is I study mortgages that become 90 days or more past due. And then in these credit records data, I ask, how likely are you to be granted an accommodation? That's a positive, like some sort of forbearance or sort of like pause on your payments. You're more likely to get an accommodation if you're at a credit union than a small bank. How likely are you to get a negative outcome, like getting sent into, collections or something of that nature? Well, you're more likely to get a negative outcome at a small bank. So both of these are indicative of some sort of way in which credit unions treat their borrowers afterwards.
So I kind of have a different interpretation for the credit score effect, which I think has a lot to do with, more competition in the prime sector. Much less competition in the subprime, and also to the extent that the benefits are concentrated on the subprime, because a lot of the mortgages are actually prime. So it kind of lowers a little bit the impact if you think in terms of, population density. So
absolutely, all very well taken points. Absolutely. Yeah. This is just kind of like speaking to, what does a nonprofit cooperative do? And I agree to your point about impact when we have to measure these, but the way I interpret it is more in terms of what is behind this cooperative aspect of credit unions. Okay, then this is to the point about the secondary mortgage market. So less mortgage reselling is associated with better loan outcomes. So in the horizontal axes for these loan outcomes, I have the resale rate at the lender level. And you see that the higher the resale rates, there's a kind of tendency towards more likely to have these negative outcomes on the loans. Okay, these don't extend to the credit outcomes, but on the loan level, there's some level of evidence to this. I think this was to Wei's question. Okay, so happy to kind of revisit this after showing this, but let me just try to conclude so that I put everything on the table. And last, this is to the questions about pre-crisis, post-crisis. I'm not showing you every analysis cut pre and post, but I am sharing with you the difference in interest rates analysis. Pre-crisis and what I call post-crisis, and then post-Dodd-Frank, right? So that's the 2012 onwards. These differences in interest rates are dramatic before, and then they kind of taper away as it goes on. So there's two ways to interpret this, right? There was a lot of opportunities to take advantage of market power pre-crisis when lending was crazy. Banks took them, credit unions didn't. But then as competition kind of became tighter and regulation got tighter, these differences, or the capacity to take advantage of these things by banks, kind of whittled away, and the differences between credit unions and banks disappear sort of time. I'm not showing you again credit outcomes and everything afterwards, but this already gives you a flavor that there is important temporal variation here. I think this was to Jose's point earlier. So let me conclude, and then we still have a few minutes, but from analyzing the mortgage market, I find that credit unions operate in similar market segments, and that's important because it means that credit unions' primary activity is not serving the most needy customers, right? That's not the kind of borrower we're talking about. But among those that they do lend to, which is kind of a broad segment of the US population, they seem to offer better prices and outcomes. And that is important too. I offer a few different possible channels, less risk-sensitive pricing, a different banking model in terms of reselling, less profit-seeking when it mattered during the crisis, more accommodations. And I interpret kind of this emergent question in terms of like these two theories, right? Altruism, which predicts that you would have lower prices and higher quality, which is kind of consistent with my findings. And the theory of non-contractable quality, which is close to the for-profits in disguise. And that one says you would have higher quality, but also higher prices, which I don't find. And so overall, this kind of evidence leans in the favor of the against the thesis of for-profits in disguise. But it's conditional on this in-member focus, right? Credit unions are cooperatives. And I think that that's an important thing to keep in mind from the perspective of, what is it that they're actually achieving socially. So thank you very much. I'll leave it there.